Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. Last year I wrote extensively about the coming era of stagflation. In this session, I want to string some of the messages from those writings together with this year's writings, along with new developments in central bank monetary policy. I don't want to repeat what we've already researched and reported on, but rather to put the many pieces in context to make your research broader, more effective, and productive. As such, I want to discuss the subjects outlined here. Regime change is underway and accelerating. What I hope you take away from this session is the regime change I am referring to is how inflation and economic growth concerns now are increasingly and unexpectedly a forcing function dictating the actions of global central banks. The Federal Reserve has until very recently mistakenly believed it had control of the economic levers. Reality is only now sinking in and resulting in forced errors. We are now facing what historians may someday label the Great Stagflation. Though it is surprisingly similar on the surface to what the U.S. faced in the 1970s, it is dramatically worse with fewer options available to what was even in the 70s an almost intractable problem. The central problem to the quagmire of inflation is going to be the U.S. dollar. It is likely to be the hallmark problem of the Great Stagflation for both the U.S. and the world. Here's where we stand today regarding the current movements in the yield curve as measured by the 5 30-year U.S. Treasury spreads. The June 16th FOMC meeting was a shocker, where the Fed signaled to hike rates in 2022. The markets reacted quickly since they saw the Fed becoming more proactive towards inflation and the strong possibility of tapering sooner the current $120 billion per month of quantitative easing. A flattening yield curve is when short-term and long-term bonds see a shrinking discernible change in rates. This makes long-term bonds less attractive to investors. Such a curve can be considered a psychological marker, one that often suggests investors are losing faith in the market's long-term growth potential. A flat yield curve indicates that those with money to loan are willing to get the same interest rate to loan their money short-term as they would if they loaned their money long-term. That's why a flattening or inverted yield curve predicts a potential recession. It's what the money lenders look for. Historically, a flattening or inverted yield curve precedes a recession. Why is that? A flat yield curve implies that those who have the money to loan are worried that loaning their money in the future will carry a lower interest rate, so they decide to loan their money today to lock in a higher rate for a longer period of time. Generally, when money lenders start to believe that there will be less demand for borrowing in the future, they loan money at a lower interest rate to increase demand. Bank stocks are already reacting to the shift in this regime change. The recent drop on the right is abrupt and normally signals a reverse in economic expectations. Though manufacturing and industrial production has improved significantly since we came out of the COVID lockdowns, we are showing signs of slowing. Evidence suggests we are soon going to peak and reverse. As this chart shows, we are not yet at pre-COVID levels, but it appears that we are beginning to stall as effectively part of an end-of-cycle economic slowing we were actually facing prior to COVID-19. This chart going back to the 2008 financial crisis brings this out clearly, and we believe the markets are now beginning to price it in. We laid out why this would occur in our March macro analytics video entitled The Coming Deflationary Tsunami. To make the points I want to make in this session, I cannot recap all the work I'm going to mention, so for expedience I will just reference it but leave it to you to revisit the actual research presentations. Though in this 53-minute video we point out the coming deflationary pressures, don't forget for a moment that we will also have increasing inflation. We will have both. It is a matter of having both at the same time but in different areas. Again, we laid out the details of this in our 40-slide October Under the Lens video entitled Inflation plus Deflation. As inflation continues to soar, industrial recovery and production will disappoint. the core ingredients of stagflation. We've already done a lot of work on stagflation and warning what we felt potentially lay ahead. Recent research now overlaps with those warnings. In early 2020, just as we were becoming aware of a potential pandemic, we were already talking of the coming era of stagflation and what to watch for. Later in 2020, we talked about what is involved in stagflation investing. In fact, we put on the subscriber side of the MataSii.com site a whole section on the return of stagflation with the core investment thesis and all our supporting posts, videos, and articles. It is there for your ongoing reference. We also laid out where stagflation likely fit into the timing of the long-term MataSii economic roadmap. I will leave you to explore all this materials as it is not at all dated and today even more important than ever to your strategic investment thinking. What is key to understand that today the stagflation problem is much bigger and more intractable than most yet realize. The way to visualize what is occurring is to think of stagflation as a potential black hole. It is easy to unwittingly and unsuspectingly get into, but extremely, if not impossible, to get out of it once one is in. The secret is to avoid it with sound economic policies before you reach the event horizon. Many perceive we are potentially entering such a situation. Their reaction is to apply traditional Keynesian thinking to the problem. But here it doesn't work. What must be done to control inflation crushes growth. What must be done to foster growth inflames inflation. It is the proverbial catch-22. The solution, therefore, is you must catch it early and aggressively. The problem is that distortions and games we've been playing for a very long time have let us get much too deep in the black hole because our measures have failed to alert us. The political kick-the-can-down-the-road policy approaches have only fostered tweaking the warning measures to buy time and make it someone else's problem. Let me be specific. Inflation, through statistical distortions such as hedonics, substitutions, imputation, and others I've chronicled, have distorted inflation as measured by, for example, the CPI to such a degree that inflation break-evens, and real rates are ineffective. I most recently laid out how the new world of inflation swaps has exploded in an attempt to protect the more sophisticated institutional investors from these mirrors and mirages. Economic growth is also seriously distorted by an obsolete formula that is based on sound money and adopted during the era of the gold standard and fails miserably to adequately describe real growth in an era of massive government debt, transfer payments, and debt-financed consumption now being nearly 70% of the economy. The creators of the simple formula never imagined an economy like the one we operate in today. Our 2017 thesis paper entitled The Illusion of Growth lays out the indisputable reality of this fact in its 111 pages of detailed analysis. The central problem and difference with what occurred in the 1970s is important to understand. We not only have an order of magnitude worse black hole problem, but our tools are dull and our thinking seriously obsolete. Our politically polarized governance is also a big problem, but which I will leave for another day. Unfortunately, as bad as this is, we have yet to be handed the killer problem we will face. The killer problem is going to be the US dollar. In the 1970s, we had a falling dollar, as shown on the left here. A falling dollar has major consequences. In the 1970s, we had a falling dollar, which caused many of the central issues: rising oil prices, rising commodity, rising gold prices. If you invested in these areas, you did well. If not, it wasn't a good decade for investors. At that time, the U.S. was the major industrial power in the world. It was the factory for the world, as Japan was only beginning to emerge as a possible low-quality producer. Just think what the world was like when there was no real competition, no Asian tigers biting at your heels, no China. The world was completely dependent on the U.S. dollar for trade and currency reserves. The U.S. had savings, as the use of credit was only emerging, and as a young worker, I can remember few had even such a thing as a credit card. We'd line up at the bank's tellers, there were no ATMs then, for cash for the weekend. It's hard to imagine the differences then versus now. But the problems are the same or are quickly becoming the same: slow growth, unemployment, falling corporate earnings, and unrelenting inflation pressures. Stagflation came in waves throughout the decade through foreign oil cartel decisions. The U.S. was highly dependent on Middle East oil and its pricing in U.S. dollars. We weren't as energy dependent as we are currently. However, our energy independence is now in serious question, as evident at the surging prices at the gas pumps since the election and shifting policies against carbon energy. The energy and commodity price pressures in the 70s flowed through the U.S. economy. Inflation-adjusted wages fell throughout the decade. Today we have witnessed the sustained drop in the purchasing power of the consumer dollar and real disposable income. The middle class is tapped out, and we are exposed to a falling 70% consumption economy and economic run rate. Real income growth is presently taking further hits from the inflation surge. On top of the fading boost to nominal incomes, the purchasing power of incomes is also eroded by the sharp rise in inflation over the past 6 months. We laid out this in the May macroanalytics video entitled "COVID Has Triggered the Next Great Financial Crisis." The central problem in the 2020s is again going to be the falling dollar. It will again have the same impact on energy and commodities, but this time, since the U.S. no longer is an industrial giant but rather a consumer of foreign products, the issue is going to be a squeeze by foreign import price costs. Falling consumer disposable income, falling corporate profits from being basically a U.S. distribution center, rising government taxes will all contribute to the downward spiral in U.S. consumptions. We can count on the Fed to be wrong and late again. We laid out this in the June Under the Lens video entitled "The Fed Hung by Its Own Rope." If you go through all the materials we've recently posted, you are led inextricably to the conclusion that the only way out of the stagflation black hole will be to somehow maintain or increase the value of the U.S. dollar. This seems like a rather Herculean task, considering all the facts we laid out in the 49-slide August Under the Lens video entitled "The Coming U.S. Dollar Devaluation," as well as our 2019 thesis paper, which extensively focused on de-dollarization. This chart illustrates how U.S. manufacturers' output has increased since 1946. For all basic purposes, the manufacturing sector stopped growing at the turn of the century. It clambered back from the downturns, but never enough to make any major gains. Chinese accession to the World Trade Organization in 2001 was a game changer, taking 2 decades to fully take hold. The U.S. dollar has typically moved with the U.S. twin deficits. The dollar weakens on deteriorating fiscal and trade deficits. These are now indicating major downward pressures. The current account is also a major contributor, which is likewise headed lower. The U.S. is no longer an industrial powerhouse with which to pay its bills. We consume more than we produce, and the decay in industrial production is as good a precursor as any of what lies ahead. Global investors seem to agree with us, with record shorts now waiting for the reality to hit. We're not calling for a crash in the dollar. We do, however, see a further 15% erosion over the next year for an overall decline of 23% since the high prior to the COVID-19 pandemic. After that, the direction will likely be up to the results of the U.S. midterm elections and the policy directions that come out of it. As shown here, we are still optimistic about the U.S. dollar relative to other fiat currencies, but we wait to the next election before making any investment predictions. All this means that our MATA-SI roadmap suggests by 2024, stagflation will be the most important topic in the media and for government monetary and fiscal policies. It will dominate investment decision-making. That is why it will be called the Great Stagflation. As I always remind you in these videos, remember, politicians and central banks will print the money to solve any and all problems, until such time as no one will actually take the money or it is of no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of fiat currencies, unsound money, political polarization, and global policy paralysis. I'd like to take a moment as a reminder: do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there has seldom been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed professional financial advisor. So until we talk again, may 2021 turn out to be an outstanding investment year for you and your family, and I sincerely thank you for listening.